Hey there, fellow traders! Let's talk risk management. It's the bedrock of successful trading. Think of it as your financial seatbelt. It won't prevent every bump in the road, but it could save you from a major crash. Many new traders get caught up in chasing profits. They forget about the flip side of the coin: potential losses. That's a recipe for disaster. Remember, in the stock market, you can be right about the direction of a stock but still lose money if you don't manage your risk effectively. That's why I'm here to break down some essential risk management tools. We'll keep it simple and actionable. By the end of this, you'll have a solid understanding of how to protect your precious capital and set yourself up for long-term success. So buckle up and let's dive into the world of risk management. Let's start with a golden rule, the 1% rule. This rule is non-negotiable, people. It states that you should never risk more than 1% of your total trading account on any single trade. Here's how it works. Let's say you have a $10,000 account. Following the 1% rule, your maximum allowable loss on any given trade is $100, 1% of $10,000. That's it. This rule safeguards your capital from significant drawdowns. Now you might be thinking, Jim, is 1% too conservative? Listen, I'd rather see you safe than sorry. This rule is especially crucial for traders with smaller accounts. As your account grows, you can gradually increase your position size while still adhering to the 1% rule. Remember, trading is a marathon, not a sprint. The 1% rule keeps you in the race, even after a few losing trades. Next up, we have position sizing. This goes hand in hand with the 1% rule. Position sizing is all about determining the appropriate amount of capital to allocate to a specific trade. Let's break it down with an example. Suppose you're eyeing a stock trading at $50 per share, and you've set your stop-loss order at $45. More on stop-loss orders later. This means you're willing to risk $5 per share. Now let's say your risk tolerance allows for a $500 loss on this trade. To determine your position size, divide your maximum allowable loss, $500, by your risk per share, $5. This gives you a position size of 100 shares. $500 divided by $5 equals 100. By carefully calculating your position size, you ensure that you're not overexposing yourself to risk. Remember, every trade carries risk, and proper position sizing keeps those risks manageable. Now, let's talk about a powerful tool in your risk management arsenal: stop-loss orders. These orders are crucial for anyone involved in trading, whether you're a seasoned professional or just starting out. These are essential for any trader, regardless of experience level. They act as a safeguard, ensuring that you don't lose more than you can afford. A stop-loss order is an order placed with your broker to sell a stock when it reaches a certain price. This predetermined price is set by you, based on your risk tolerance and trading strategy. Think of it as your safety net. Just like a safety net catches a falling acrobat, a stop-loss order catches your falling stock, preventing further loss. It automatically limits your losses if a trade moves against you. This automation is key, as it removes the emotional aspect of trading, allowing you to stick to your plan. Let's say you buy a stock at $30 and set a stop-loss order at $28. This means that if the stock price drops to $28 or below, your order will be triggered. If the stock price drops to $28 or below, your order will be triggered, and the stock will be sold, limiting your loss to $2 per share. This way, you can manage your risk effectively. But stop-loss orders aren't just about limiting losses. They can also be used strategically to lock in profits as the stock price rises. They can also help you lock in profits. For instance, if a stock you bought at $20 rises to $30, you can move your stop-loss order up to $28. For instance, if a stock you bought at $20 rises to $30, you can move your stop-loss order up to $28 to secure a profit of $8 per share, even if the price drops. This way, you can protect your gains. Stop-loss orders are a must-have in your trading toolkit. They are indispensable tools that help you navigate the volatile world of trading with more confidence. They provide peace of mind and protect you from unexpected market movements. By incorporating stop-loss orders into your trading strategy, you can trade with greater assurance and focus on your long-term goals. Section 5. Risk tolerance and emotional control. Now let's talk about two crucial aspects of successful trading: risk tolerance and emotional control. These are intertwined and play a significant role in your trading decisions. Risk tolerance refers to your capacity to handle potential losses in the market. It varies from person to person. Some traders are comfortable with higher risks, while others prefer a more conservative approach. Emotional control is equally important. Trading can be an emotional roller coaster. Fear and greed can cloud judgment and lead to poor decisions. That's where risk management comes in. By having a solid plan in place, you can take the emotion out of trading. Stick to your strategy, even when things get tough. Remember, successful traders are disciplined traders. They control their emotions and make rational decisions based on their analysis and risk management plan. Section 6: Hedging and Diversification, Advanced Risk Mitigation. Now let's move on to some advanced risk management techniques, hedging and diversification. These strategies can further protect your capital and enhance your trading performance. Hedging involves taking an offsetting position in a related asset to reduce your overall risk exposure. For instance, if you're bullish on a particular stock, you might consider buying put options as a hedge. Put options give you the right to sell the stock at a specified price, limiting your downside risk if the stock price falls. Diversification is another essential risk management tool. It involves spreading your investments across different asset classes, sectors, and geographical regions. By diversifying your portfolio, you reduce the impact of any single investment on your overall returns. Remember the old adage, don't put all your eggs in one basket? Diversification is the embodiment of that principle in the world of finance. Section 7: Real-world examples and success stories. Now let's bring this all together with some real-world examples that illustrate the principles we've discussed. One of the most famous examples of risk management in action is the story of George Soros and his quantum fund. Soros is renowned for his strategic thinking and ability to foresee market trends. In 1992, Soros made $1 billion bet against the British pound, correctly predicting that the currency would depreciate. This event is often referred to as Black Wednesday. However, what many people don't know is that Soros also hedged his position by buying German Deutsche Marks. This move was crucial in balancing his risk. This hedging strategy protected his gains and mitigated his losses if his prediction had been wrong. It was a calculated move that showcased his deep understanding of risk management. Soros understood that even the best traders can be wrong, and he always prioritized risk management. His approach serves as a valuable lesson for investors. Another example is Warren Buffett, one of the most successful investors of all time. Buffett's strategies are often studied and emulated by investors worldwide. Buffett is a strong advocate of diversification and a long-term investment approach. He believes in spreading investments to minimize risk. He famously said, "Diversification is protection against ignorance." This quote underscores his belief in the importance of understanding one's investments. It makes little sense if you know what you are doing. Buffett emphasizes that knowledge and research are key to successful investing. Buffett's investment philosophy highlights the importance of spreading risk and taking a disciplined approach to investing. His success story is a testament to the power of informed and strategic decision-making in the financial world. Section 8: Practical Tips for Implementing Risk Management. Now let's get practical and dive into the nitty-gritty details. Here are some actionable tips to implement effective risk management in your trading strategy. 1. Determine your risk tolerance. This is the foundation of your risk management plan. Before you even think about placing a trade, take some time to assess your risk tolerance. Understand your financial situation and your emotional capacity to handle losses. How much are you comfortable losing on a single trade? This is crucial to know. What is your overall risk appetite? Are you conservative, moderate, or aggressive in your approach? 2. Use stop-loss orders religiously. These are essential tools in your trading arsenal. I can't emphasize this enough. Stop-loss orders are your safety net. Stop-loss orders are your best friend. They automatically sell your position if the market moves against you. They protect you from catastrophic losses and help you sleep soundly at night, knowing your downside is limited. 3. Calculate your position size carefully. Don't just wing it or guess. Use the formulas we discussed earlier to determine the appropriate position size for each trade based on your risk tolerance and stop-loss level. This ensures you are not overexposed. 4. Keep your emotions in check. Emotional trading can lead to poor decisions. Trading can be exhilarating and nerve-wracking at the same time. It's easy to get caught up in the moment. Don't let your emotions cloud your judgment. Stay disciplined. Stick to your plan and make rational decisions based on your analysis. 5. Diversify your portfolio to spread risk. Don't put all your eggs in one basket. Diversification is key. Spread your investments across different asset classes, sectors, and geographical regions to reduce your overall risk exposure. This way, if one investment performs poorly, others may perform well, balancing your risk. Section 9. Conclusion. Risk management is key to long-term success. So there you have it. Risk management is not glamorous, but it's the foundation of long-term success in trading. Remember, it's not about avoiding losses altogether. That's impossible. It's about managing those losses effectively so they don't wipe out your account. By implementing the strategies outlined in this essay, you can trade with confidence, knowing that you have a safety net in place. Remember, protecting your capital is paramount. Once you have a firm grasp of risk management, you can focus on what really matters, finding winning trades and growing your wealth over time. Happy trading, and may the odds be ever in your favor.